Ladies and gentlemen, welcome to another edition of Independent View with Lobo Tigre. Normally, I would be grilling a CEO of a mining company in our interviews, but we have a special treat for you today. And it's interesting because one of the most frequently requested guests I've had is Mike Oliver. He's the founder and chief analyst of Momentum Structural Analysis. And when a bunch of my readers, who are generally pretty smart folks, tell me that I should talk to somebody, then that gets my attention. Now, most of my audience knows that I'm much more of a fundamentalist and not a technical guy, and Mike is the technical guy that most of my readers seem to listen to the most. So I'm delighted to have you with us, Michael. I've got a lot of questions for us, but why don't you go ahead and tell us, briefly about momentum structural analysis, and then we'll dive right in.
Sure. Glad to be on your show, Lewis. MSA started in 1992. I was more or less solicited by Wachovia Bank, that was headquartered in North Carolina at the time. They found an interest in my momentum work. The trust department of the bank and the bond department of the bank, it was headquartered in North Carolina at the time. Wachovia no longer exists, by the way. And so they said, have you ever heard of soft dollar? And I said, no. And then what it was is when they generate commissions, the broker dealer they deal through can kick back some of those commissions for research. And so I got into the research business, exiting the futures brokerage side of the business. Our method of analysis treats price secondarily. In other words, we're not normal technicians. We always look at price charts. We always include them in our reports. But our primary focus is on momentum of price. And we don't measure momentum in the popular ways that most people have on their computer screens, like RSI and MACD, these things that are free on your screen. We developed our own methodology of plotting momentum. And we find that by using momentum as a mode of trend analysis, that when trend changes are about to occur, you can see the evidence building on the momentum chart, whereas the price chart might not be exhibiting indications of trend change. So, whether you're talking about a short-term trend change or a very long-term trend change. And in order to analyze a market thoroughly, and what we do in our reports is we look at all four asset categories: debt markets, equity markets, foreign exchange, and commodity markets, and the key components within those areas. And we tend to prefer to look at long term, what's going to happen over the next several quarters or a couple of years, not what's going to happen next week. In which we're not in there nickel diming the markets. You can nickel dime to death. All markets trade. They go up, they go down. And sometimes the ups and downs are irrelevant to the major trend. But anyway, we do analyze the trend direction of markets via momentum. And later on, we can get into some of these charts if you want to look at what I'm talking about. But, there's some very interesting situations right now that we think are setting up. Our focus in the stock market, for example, is not the S&P 500, not the Dow, it's the Nasdaq 100. And for obvious reasons. And the obvious reasons are 50% of that index is comprised of 5 companies, okay? And we all know the names of them. And all of these stocks went ballistic this summer. In fact, they went into blow-off, straight up moves, vertical, which was not replicated by other indices like the Dow or the Russell small caps or Europe or anything. It was just the 5 narrow names that went totally ballistic. And so we consider that to be the leader. And it's our argument that when the leader fails, the entire market will fail. And no matter what the sector is, it's going down with the blow-off markets that are inverting. And we think they're in the process of that right now, in the early phases of a failure from the summer blow-off. And we measure that via momentum, and we can look at some of those charts to see why we think that. And the other major asset category right now that few people are talking about, they're all looking at the interest rates, they're looking at gold. Few are looking at the broad commodity complex. And we look at, as a major index, we look at the Bloomberg Commodity Index, because it's a very well-balanced futures-based index. There are some commodity indices that are heavily weighted to energy, probably too much so. So they look more like oil than they do the grains or sugar or coffee or copper, etc. Bloomberg is well-balanced. And it's our assessment that Bloomberg is now broken out. Now, so far there's no fireworks. It's a quiet breakout via our momentum methods. But when that asset category turns up in a way that becomes noticeable and becomes noisy, which we think it will, that's suddenly going to disrupt a lot of assumptions that people have, fundamental and technical, about other asset categories. Like, what does that mean for yields? What does that mean for the stock market if smart investors are moving their assets into commodity-related markets or commodity futures markets? What does it mean for does it bleed money from the stock market? And yes, it will, believe me. Anyway, that's another area that we think is extremely important now, not just the blow off in the tech stocks, the narrow tech stocks, but the upturn in commodity prices. And so that's mainly what our charts are about today.
All right, Mike. Well, I definitely want to get to those, and it's music to my ears to hear you talk about the commodities writ large. And I've had the same criticism of a lot of the energy-heavy commodities perspective. It skews things. But before we go there, I want to cover some basic questions, just so people know a little bit more about what you do and what it means before we get into what you're saying now. And as a fundamentalist, I have to ask, my first question is, can a good technician ever afford to ignore the fundamentals? Is it one of those things where I've heard people argue that the fundamentals are distractions? I'm going by what the data tells me in these charts, and I should not look at anything else. And that always upsets me. It seems like the weatherman who won't stick his head out the window to see if his model is right. Where do you come down on that?
Well, I respect fundamentalists, and in fact, I think about fundamentals all the time. And I have my own sort of background framework of that. I originally came from political philosophy, not markets, when I joined E.F. Hutton in 1975 and when gold was legalized. I had quit work on a PhD at University of Hawaii in political philosophy. And that was during a Great Recession, if you recall. 1974-75 was the global stagflation began. And I knew I wasn't going to be able to get a job because I was of a libertarian background. And at that point in time, there are a lot of libertarians on campuses now, but there weren't back then. And therefore, I joined the E.F. Hutton Commodity Division in New York because gold was legalized, and I had a fundamental, heartfelt appreciation of gold. In fact, a lot of people don't know this, but gold was legalized largely due to the efforts of the committee to legalize, National Committee to Legalize Gold out of New Orleans, which is a libertarian group. And they actually lobbied it through Congress, including getting liberal votes, enough to pass it. It sort of sneaked by. And that's how gold was legalized in the U.S., largely because of that one group. A guy named Jim Blanchard, I guess he still has a gold silver company down in New Orleans, a coin company, was the leader at that time. But anyway, so yeah, I have a fundamental appreciation of markets. And sometimes those fundamentals I have to put on the back shelf because the technicals say no. Example being, we had a great bull market in gold from the early 2000s through 2011. In fact, it was going up along with the S&P during that, especially 2000, let's call it 2009 low through 2011. They both went up nicely. And gold went up a lot more than did the S&P. But that would confuse a lot of people because, if gold's going up, that, et cetera, et cetera. Now they've gone to the new view that, well, no, gold and stocks do move together, which we don't buy either. But in 2011, as gold was pounding its chest above, 1900, 1800s, our work said no, topping out. And in fact, we turned negative in January 2012. Gold was just under 1700, a couple hundred off its high. And the market flopped around for the year, all during 2012. It tried to make new highs, went back close, dropped down to the 1500s, go back to on near 1800, et cetera, just flip around. It wasn't until the spring of 2013, gold finally collapsed. It crashed, in fact. But our work, Annual Momentum of Gold, said, be out of gold in 2011, 2012. And sure enough, it was a top. Now, that fundamentally, I couldn't explain why I should get out of gold. I still had a long-term bullish appreciation of gold. And yet our technical said, be gone. And so we were. We didn't get bullish again until February of 2016, again, based on our technicals. But all during that time, my fundamental appreciation of gold and what central banks are doing to fiat currencies still said, no, be positive on gold long-term, but don't own it right now. It wasn't again until 2016, 3 or 4 years later after the top, that there was technical evidence that, okay, green light again. And so that's how I have to balance out my fundamental views, which tend to be ongoing and directional. Right. Go ahead.
But Mike, so what you are saying is that the technicals do trump. Like as a libertarian, as a hard money advocate of all that money printing back in the first global financial crisis, that made you bullish. But what the technicals were telling you, you went with that over your philosophical sentiments.
Right. I had to put it in my back pocket. My fundamentals have to go in the back pocket, because there's times when the fundamentals might still be there, ongoing, but the technicals say, no, I'm gonna take you down.
That's gutsy.
You just have to recognize that and step aside and use it as an opportunity.
That's gutsy. Hats off to you, because I drank the Kool-Aid back then, so I tip my hat to you. So, without getting too deep into the weeds, Mike, can you explain to the audience who doesn't know a little, what are the key things that differentiate your MSA from typical technical analysis? I get that, momentum gives us a clue, right? It's not just the price today, but without giving away your secret sauce, how does that work?
Well, in a broad way, one way to explain the use of momentum is, and we'll see this in the charts we look at later, but when the technicians put up a chart of something, they quite often will overlay a moving average on it. Maybe it's a 200-day average. The Wall Street Journal uses 65-day average when they plot their daily charts of the Dow and the S&P. And they just overlay it on the price chart as if crossing that average might mean something. And quite often it doesn't. Okay, seen many breaks below 200-day lines that don't mean anything. It's like a coin toss. Sometimes they're meaningful, sometimes it's noise.
Sorry, let me jump in on that, Mike. Sorry. But, that's something that people talk about a lot, these golden crosses, death crosses. And I wonder, I've looked at those, and sometimes, that seems predictive, but other times, how often do those things mean anything at all?
I've not done a scientific study of it, but I'd say that even good use of orthodox technical analysis, meaning price chart analysis, is 60-40 at best in terms of being on the right side. And then sometimes when you're wrong, you're really wrong. Because it's a trap. The cross occurs and you go with it, and then they rip your head off. And quite often when it is a false move by price, it will rip your head off, because in other words, it shouldn't have done it.
Right.
And when the people that went with the supposed good signal, they did it in a crowd, right? Why? Because everybody's looking at the same charts, the price charts. And then if the crowd is wrong and the string gets pulled, they panic and you get an instant reversal back in the other direction. Dangerous, if you're on the wrong side of that. Not a slow turn, but a rapid one. The one fundamental reason that should make sense to everybody of why what we do makes some sense is when we measure price against a moving average. It's particularly a long-term moving average. Let's say a 3-year average, and we go back 10 years in a market and we plot an index and you overlay the 3-year average on a price chart, but then you plot a momentum chart of that same market where the bars, the high and the low and the close each month is a bar, but instead of on a price scale, it's on a relative scale to where that moving average is. So it's an oscillator where you have a zero line. Zero line is that 3-year average.
Understood.
And this month's high or low is either above or it's below that moving average. And so each month you plot your bars, and it creates an oscillator, a breathing pattern. Quite often, those charts will develop structures, evident lines of support or trend lines that you don't see on a price chart. But there's a good fundamental for that. Especially this is true when you look out longer term. And longer term now, I'd say, is a year or more. Money supply changes are so dramatic. Since 1959, M2 in the U.S. has almost doubled every decade. It's like 90-something% uptick in the supply of the money units. Well, that means if I bought a stock 10 years ago, in 1969, and it's now 1979, and my stock was $30 and it's now $50, am I really up? Considering money supply about doubled? I mean, when I was a kid, a loaf of bread was, under 20 cents. Now what's a loaf of bread? Do we have a wheat shortage or something? No, of course we have a degradation in money units. And now the degradation in money units has gone rampant, so that it isn't even a long-term issue. In 4 or 5 months, we've taken money supply of 50%. It's off the page. And we've had a promise from the central bank that they won't quit. There's no reason to quit. And believe me, they're going to have fundamental reasons to continue. And those are upcoming. Street-type situations, unemployment, rent problems, all these compounded errors that have now been exposed by the virus, errors that were built over the last 10 years, in fact, not caused by the virus, but debt, which was accumulated. So anyway, that fundamental of the change in the money unit, which is how we measure price, right? Stock is worth $30, $40. The change in the underlying money unit is a variable that is as important as the price of the stock or the commodity. And if you don't factor that in, then you're missing a large fundamental there. And by putting it on a moving average and measuring a market versus that changing moving average, which it causes to change, both the degradation in the money unit and the movement in the asset itself, you're measuring against a relative yardstick, not a fixed yardstick like $1, which seems to be the same. In fact, I use the metaphor, if you're a home builder and you got to but maybe take 6 months to build a house and you've got a yardstick and it says 36 inches. But in fact, that yardstick grows an inch a month, but it still says 36 inches. Can you imagine the nature of the home you just built in terms of quality, stability? Okay, well, that's the same thing with the money unit being used as an objective measure of an asset. It's not an objective measure. So we try to back it out by adjusting via the moving average, which is a changing dynamic. And so fundamentally, that sort of explains why we do this. And then when we look at the charts, you'll see that, in fact, oh boy, it does say different things than does the price chart.
Okay, so when you do this and you look at the charts, I'll give you a freebie here because, and I should say to the audience, we have no business relationship between Mike and myself. I'm not an affiliate. I'm not getting any commissions if anybody signs up for his services. I'm just doing this because it's interesting and I want to know about this subject, and so do many of my readers. But so, Mike, in your service, when you do this, do you make predictions? Do you say, "Oh, look, this big signal is important, therefore, get in or get out of this sector or these investments"?
Yes, we usually almost always have specific numbers, so it's not just blabbing on about, well, this looks good, this looks bad. We have the charts, we have numbers, we have arrows, we point to things. We say if this occurs. Usually, we're ahead of the game, meaning we don't wait to the breakout to occur on momentum and then say, oh, by the way, market A just broke down. Now, a week or two ahead or a month ahead or 6 months ahead, we're showing these structures that are pending as breakout structures and saying, we've got to watch this market because it's built a floor. And if it breaks that floor on momentum, it's going down. And certain attributes exist on the momentum chart that suggest it's going to break down, such as, for example, a non-confirmation. Let's say there's a market that's advancing in price and its momentum is too, but all of a sudden in some 6 month period, and this happened, by the way, in 2011, 2012 on gold, making new highs that aren't confirming, meaning momentum's not making a new high. Similarly, at the bottom in 2016, we had a situation where you were turning up dramatically in momentum, but it wasn't evident on price. But we could see it coming because momentum had built a structure. The kind of structure, what I mean by structure, is the same thing that price chart guys look at. A structure would be, let's say, a floor on a stock or a ceiling or a trend line. We're looking for the same type of structures, but in momentum. And we pre-identify them, we assign numbers to them, and those numbers change. The reason the numbers will change over time is that we're measuring a market versus a moving average. Well, that moving average changes. And therefore, what it might take this month to break below an annual structure could change next month when the 36-month average rises a bit. And so breaking the zero line next month rises. So we adjust the numbers as well. So yeah, we are number specific.
Okay, so give me a comparison. If you, I don't know if you have these numbers at the top of your head, but let's say there's some price that has a critical support level, and there's the MSA critical support. And if it breaks below that, in regular technical analysis, how often does breaking below critical support actually, telegraph worse to come ahead versus MSA?
Usually, let's say 50-50. You'll get a coincident break in price with momentum, but usually momentum will break first. Almost always it'll be ahead of the game, where when you're looking at the momentum chart, one, you can see the vulnerability ahead of time, meaning the potential floor, let's say. And when you look at the price chart, you don't see a floor, so you're not scared. There's nothing to break, right? Zigzags don't matter. But on the momentum chart, you can see the structure. It smacks you in the face. You don't have to be smart. You can look at the chart and see it. 12-year-old can see it with a crayon. And therefore, you get a warning in your eyes and in your guts that something's to be watched here. I use the metaphor of the bridge on the River Kwai. They didn't blow it up till it got built, right? And remember, they put the dynamite kegs under it and then blew it up. You can't break a trend until there's something to break. And usually that something to break is evident on momentum and not necessarily evident on price.
Okay, but what I'm saying is, like you said earlier, that conventional technical analysis, and we didn't talk specifically about floors, but conventional technical analysis is roughly right 60% of the time. In MSA, when you look at a breakdown in MSA, is it better than 60% of the time?
I have never done a study, but I would say it's more like 80-90%. I'm serious. I'm not trying to gloat or boast. And our subscribers tend to stay with us for that reason. Our continuation of subscribers year by year is pretty high compared to most research reports. And I think it's because we generally are pretty accurate in our calls, and the calls tend to come before everybody else that they're meeting at a cocktail party is talking about the same thing. They know the stock market's in trouble before their fellows do. And therefore, the anticipation of the possible event readies them mentally and perhaps portfolio-wise to be able to act in a timely way rather than chasing a downside breakout or an upside breakout.
Understood. Okay. A couple more quick things before we get to your analysis of what's going on today. I've noticed in looking at some past editions you were kind enough to send me that I don't see the traditional candlestick type charts. Are those not useful, or does something technical?
They're useful. I think if you use price charts, candlesticks are probably the best mode of looking at price, because they give you a lot of information. It might have been an up day, but you close near the low of the day, therefore it could be, hanging, and so yeah, I do have respect for that in price chart analysis. But again, our emphasis is on momentum, and I'll quite often glance at candles just to see if they're saying something that might be in agreement with the developing momentum situation. But it's just a better way of looking at price. I would agree with that. Absolutely.
Okay. All right. And I had more questions about different patterns, but I understand that you do things differently, so maybe those aren't terribly relevant given what you've said. But is it more general thing? Like, for example, one reason why I've not embraced too much technical analysis myself is because I have read things before, and people do make predictions, and then it turns out that, well, it wasn't quite that way. It's because of this, or so, like, for example, oh, there's a clear head and shoulders pattern here, and now we're on the second shoulder, so it's all down. And then it doesn't go down. It goes up even more, and they say, oh, well, it turns out that head and shoulders, that was just an initial shoulder. Now it's a bigger head and shoulders. And it seems like they rewrite history a lot. And is that, so is that just unscrupulous people? Or how do you know if something like a head and shoulders pattern really is a head and shoulders pattern and not just,
Well, we notice that if a price develops something like that, we'll notice it, but we still treat it as secondary. If, for example, we have a negative momentum situation and you have a price chart head and shoulder top as well developing, then, we give more credence to the price chart head and shoulder top as being a price chart head and shoulder top, because momentum says you're going down. But again, usually momentum will tend to lead that. One rule on price chart heads and shoulders, by the way, if you've got a head and shoulder and the right shoulder and you break through the neckline, put your stop above the high of the right shoulder. You don't want to go back there again. Okay, just a price chart analysis comment. So if you're using that type of pattern, don't put your stop above the high of the head. Put it above the high of the right shoulder, somewhere halfway between and the neckline. So anyway, one thing in price chart analysis we do use quite often is parallel channel analysis. We also use that in momentum. And I knew a guy at EF Hutton, a guy named Art Scleroux, who was back then was a plywood specialist. Believe there was a plywood futures market then, in 1975, 76. And I spent a couple of weeks working with him. And he wrote a book called Techniques of a Professional Commodity Chart Analyst, which is probably the best technical book I've ever read. In fact, I recommended it in our reports frequently. But he developed a mode of channel analysis of price, which I consider to be probably the most effective use of price. And he explains how to plot a channel, because you can plot it wrong. And he shows how you do it. And it doesn't seem logical what he does, but it's right. So there are some price chart patterns that I do have some respect for, and that would be one of them. But that's not one of the more common, popular patterns. In fact, I don't hear talked about much at all in parallel channel analysis.
Well, by accident, I could say, and I'm probably doing it completely wrong, but I've been looking, for example, at uranium and looking at the series of higher highs and higher lows, and it gives me comfort when I see the parallel trends. I put a top, an upper and a lower bound on it. And we keep breaking the upper bound, and we keep not breaking the lower bound. I'm not a technical analyst, but that looks good to me.
That sounds like it. We've turned positive on uranium a year and a half ago, and it's continuing to hold and firm, and it's still cheap.
Yeah. All right. Okay, so let's... I have a million more questions, but we don't want to make this go on for too long, and I really appreciate your time. So why don't you go ahead and tell us about your current outlook, what you're working on now. I know you prepared some slides, so go ahead and tell us what you think is important right now, please.
All righty. The first set, we get three sets of charts on the Nasdaq 100. And what you're looking at here on the top chart, the top chart is a price chart, bottom chart is a momentum chart. In this case, we've got what you would call an intermediate trend metric, 3-month moving average. It's not long term. Usually when you break a 3-month average structure in momentum and change the trend of the 3-month average momentum, which we call intermediate again, it might persist for a handful of months. If you did that same thing on, let's say, a 3-quarter moving average oscillator, it might last for 3 to 5 quarters, the new trend.
Okay.
If you did it on an annual, it might last for a couple of years. Okay, but anyway, here we're dealing with intermediate trend of Nasdaq. And what we've plotted on the top chart is the day-to-day action since the low in March of the Nasdaq 100 to the highs. And this is we're day 2 behind on this right now. But anyway, and we overlaid the 3-month moving average, which changes, of course, every month. And of course, it's been rising. Okay. Now, what we do on the chart below is plot those bars, those day-to-day bars, in their relationship, how many points above or how many points below that 3-month average, which is the zero line. Okay, and as you can see from the March low, about in April, mid-April, you got above the zero line and you price really started to soar. So did momentum. Momentum got up to as high a levels, 2,000 points over the 3-month average, as was the low in March. So if the March low was oversold, then the August September high that was an August high actually, was pretty much overbought, sort of fair and balanced, in terms of breathing below and above the zero line. That's not always the case, but in this case it was a balanced swing. But now look at the upper red line on the momentum chart. Now that goes back to a low in June, July, August. Repeated lows at the same relative level to the 3-month average. Now, when you look at the price chart, those lows don't line up. They're not horizontal. They're upward, okay? But on momentum, there's a floor, okay? So you can see, as you were into the late strength in August, that there's a floor underneath you, and you better not break it. Well, by default, when you opened the month of September with another jump upward in the 3-month moving average, meaning the zero line adjusted up in terms of what its price equivalent level was, that caused momentum readings to drop. You also had some price drop there, 1 or 2 days off the highs when you broke that structure. At that time, the price of the Nasdaq was 11,600, right? And then we traded in the next 2 weeks when you broke that upper line. You dropped another 1,000 Nasdaq points, and you stopped where? around the zero line. At that point, we warned our subscribers, okay, we sort of could go neutral here because this thing may try to hang in here around that 3-month average. And sure enough, it did. It bounced off of it in September, came back down in early October, again held it. It got slightly below it, but incremental, very marginal. And then shot up again this month. And notice where the rally high in momentum failed. Underneath the prior broken structure. Now, when you look at the price chart at the secondary high, there's no particular reason for it to have stopped there. It didn't stop at the old high. You know, it was nothing obvious. But on the momentum chart, you can see that that rally that we had early first, second week of October was bumping under the old floor, which might, in fact, reverse polarity and become resistance, which it did. Okay, since then, we've dropped back off. And today we've traded, this is not today's action. Today we've traded below, slightly below the red line, down to the red line, let's put it that way, below the 3-month average, and are trying to hold again. The problem is, by falling back to that structure, which is now a 3-point floor, okay, even assuming you hold it, okay, let's assume you hold between now and the end of the month. As soon as we roll into November,
right,
the 3-month moving average is going to jump again. In which case, if you find yourself trading anywhere around current levels, I'm going to blow that floor out. So momentum by default is going to break that next floor, which is probably more important in terms of breakage than the first one because it's at the zero line. It's at the moving average. In fact, the Wall Street Journal running their 65-day average would come up with, if you oscillated versus it, you would come up with a similar chart. Why? 65 days, about how many trading days in 3 months. Except it changes daily. But anyway, this is how momentum develops structures that are not otherwise evident on your price chart and how we try to make our calls. So our next call is when we break below that lower red line by a credible amount, you're headed down again.
Mike, can I ask about a credible amount? How do you know when something blips just below a threshold and that's not a big deal, it's just a few pennies, don't panic. And when it's a credible, without being too late, how do you make that call?
Well, you don't want to be too late, but the lower chart again, okay, you'll notice that the low in September and October are about the same. In fact, the low in September, the first low there, was about 100 points below the zero line. Just keep that in mind. The low in October was 82 points below, okay? So I'm going to round it off and say if you trade 150 points below, you've credibly taken out that support.
Okay.
Rounding it to a 50-point increment. Okay. So that's where our trigger number is now. It's 150 below the 3-month average. That is a credible violation of that structure. And sometimes it could be even more precise where it's almost perfectly exact, and I'll show you some of those charts in a minute. But that's a pretty good structure there. They're within, 10, 12, 18 points of each other, those two lows, the September and the early October low. And if we go through that in November or later in this month, then 150 under to us is sufficient breakage to say, okay, that's pull the trigger. Okay.
Understood. Okay, very good. You said you had another example prepared?
Yeah. Now, this is Nasdaq 100 annual momentum. And this is the bars on the top are monthly. We go back to 2009 low on the left. And so you see the 11-year bull trend. Okay. And we overlay a 36-month moving average, which is a smooth version of a 3-year average. The only difference is you adjust your 36-month at the end of each month, you adjust it up a bit because it's a rising market. So what we do on the momentum chart below is we're plotting those same bars in terms of their relationship above or below that zero line, that moving average, what percent above or below. We do it on a percent basis because the dimension of the chart is such that you've had an enormous move, and to measure it on an arithmetic basis would be deceptive. It's better to smooth it by doing it on a percentage basis. So we plot each of these monthly bars in their relationship to the 36-month average, how much above or below. Well, you can see that in mid-2010, we got above the zero line. You had that pullback at the late 2010. It took off. And you've never closed a month below the zero line. You've traded below it a little bit in late 2010 and just a tick or two below it in the crash in March. But basically, zero line has been a broad level of support that it is not used constantly because, like the 2016 low and the December 2018 low, stopped in front of it. Okay, but look at the top. All of the highs, 2012, 2014, 2018, and early 2019, and also if you look at the spike up there in January this year, all of those got to 40% plus above the zero line. In fact, most of them were like 41, 42% over. And a bunch of those were monthly closes. So what is that? That's a ceiling, right? Okay, so that's resistance. But after the March low, we went up and took that out this summer. And that's when the Nasdaq went into blow off. And what blow off means is that your rate of angle of increase of price and evident momentum here increases. So you're no longer going up rationally, you're going up, in a panic. It's grabby. And when you have an emotional move like that, quite often they unravel emotionally because the price guys don't know where to buy it if it turns down. They don't have any reference points that are anywhere nearby. I mean, you look at that price chart and tell me, where should I be a buyer of this thing? Nowhere nearby anyway. If you drew an uptrend line, it comes through at about 7,000 something. So that doesn't give you any help. We're 11,000. On the momentum chart, though, last month and this month dropped down to the 40% level. And so far, holding. Now, if we ever close a month at 40% or less above the 36-month average, meaning below that red horizontal, we define that as a momentum abort. It's like an elevator going through the top of a building and then falling back to the top of the building. Okay, in other words, the attempted liftoff is aborting. Like one of those old Cape Canaveral launches back in the 1950s. You saw the missile go up and then blow up in midair and collapse back to the pad. Well, that's how blow-offs behave. And we define this as a blow-off that is likely to fail. And its first failure structure is that upper red line. And so every month we adjust what number we need to see on the Nasdaq 100 in terms of a monthly close that aborts back below that ceiling. Because if you do, flip to the next chart now. This is that same chart, but plotted on a monthly closing basis, which we don't care about highs and lows. We just say, oh, okay, end of the month, where's the price? Plot it. End of the month, where's that price in relation to that 36-month average? You can see the same ceiling here. At more than 40% over, repeatedly hit. If you close a month out below that upper red level, that's our abort. And we argue that you will rapidly move to next support, quote unquote, around support. This support line defines the 2016 monthly low close, the December 2018 monthly low close, and the low close in March of this year. All of them were above 10% over the mean. They were all within decimals of each other. 10% plus over, 10% plus over. So you look at the price chart, and you don't have a floor. You don't even have a good uptrend line. You've got an upward curve. Okay, but on momentum, you have a flat structure that is pristine. So we argue that if you break that 40% over, you're probably going to drop rapidly to the next support at 10% over. But if you ever close at 10% over or less, we're going to blow out that floor. And we suspect at that point a major bear market in Nasdaq 100 will be underway. A bear market that was preceded by what? A blow-off. Not uncommon.
Not uncommon. Well, that makes sense. Wow, that's so valuable heads up there. It'll be interesting to see if you're right. We'll have to follow up afterwards and see how it plays out. Mike, you've been very generous with your time. We're already 40 minutes into this. I think I've got a squall blowing up here in Puerto Rico. But there's more to the world than gold. But I got to ask you about gold. People are excited. They're worried. The all-time high, which in real terms, and I agree with you about tracking things in real terms, not elastic dollars. In real terms, we don't actually have an all-time high in gold yet, but still, that psychologically important 2,000 number. Can you share with us anything about your outlook on gold now? Do you think it has peaked already or still has higher to go? What does your technical side tell your fundamental side?
Okay. It's a daily gold chart. This is a few days old. So we've dropped since then. We're down to pushing toward 1860 on spot right now, maybe 1865. So a little lower than you see there. But anyway, this is day-to-day gold. And we peaked in August, early August. And by the way, this is what we're using here to measure is a 15-day average. Well, what's that? Well, that's a 3-week average. So it's fairly short-term average. Only we adjust it daily because instead of adjusting every end of every week for a 3-week average, we adjust daily 15-day. Okay, so it's a short-term indicator. But when we did peak, it was fully confirmed by momentum. Momentum was making very strong readings as well, so there's no sin up there. It just was sort of overbought, okay? And then you had a very sharp drop. And since then, you notice the momentum low was very deep as well. In fact, the momentum low went off the page almost. But then you came back, and what did you do for the next month in price after that low, month or two, in fact? It went sideways. In other words, the emotion of that collapse created an obvious low. And then you went sideways where it was a dual. It was really a horizontal market. But this is all, for momentum, this is a corrective period of time where it went from an overbought level in early August down to below the zero line, spent most of its time, 30 to 40 points above the line down to 80 to 100 points below. So it was corrective for momentum. Momentum went from very high readings and submerged itself, cooled itself off. And yet price didn't really fall apart. In fact, you look at the price of a few days ago there, you could draw a line back to the left and you're back where you were in August, September, et cetera. It's boring almost. And yet everybody's panicked. Well, what we have on momentum and price here, but on momentum we have a ceiling. And it's defined by the lower line, which was with high closes back in August, September, which you actually marginally closed above in October. But the high intraday trades on the momentum chart they're at about 40 over, you'll notice. 40 points above the 15-day average, okay? That's a structure. Meaning if you ever get a day that blasts through that 40 over, your 15-day average, 40 points, $40 above it, momentum's breaking out. Now in the process, we've also developed the parallel channel I was talking about. And here's how we plot that on price. So we have price is also giving us an indication. You take the low closes in the decline. Just focus on the closes. So you draw a line through them. That's your angle of descent defined by the lows. Then you take a parallel ruler and you plot across the high close. And you don't touch it until about 2 weeks ago, we bumped that line. That's when gold was up around 1920 in price. And you backed off. Now, the backing off from there, this is not up to date. Again, it's about a week behind. You've got now a validated parallel channel, meaning the lows are defined by 3 low closes, and now you have the upper end of the channel defined by that failure that we had a week or 2 ago when we were in the 1920s. So that pullback is actually helpful because it says, yes, your channel top is valid because I just hiccuped at it. Okay, so we now trust that channel top. So going forward, you get gold much above 1910 or so on this chart. And I'll be breaking out above that parallel channel. And what we'll want to be seeing too is that the momentum chart at the bottom is blowing through that upper red line. Because if it does, then it says, okay, correction over. And this is based on short to intermediate term indicator here. This is not long-term. Long-term momentum, it doesn't even acknowledge this pullback. It's not doing any damage whatsoever. It only shows up on the shorter term stuff. So to look for this short-term trend downside or corrective, mostly sideways, we're watching both the parallel channel on price, which we think is a valid technical tool, and the absolute clear, very clear ceiling on momentum.
All right. Well, it's interesting to see how. Sorry, Mike. If I could just say about that chart, it's really interesting how it shows how the lower portion, your momentum chart, and when you come up against the red, and how that corresponds with the upper bound of your channel analysis there.
Right. They're both basically in agreement with each other. Yeah. All
right.
And
so
the fact that they've set the structure is important.
Okay. So, but
you can't break a trend. Go ahead.
All right. But where are you at right now? Are you bullish or bearish? Are you waiting for that upper trend to be broken?
I think gold has a long-term bull trend that we don't know where it's going. Off the page. you know, 10,000 an ounce, 5,000, you name it. So it's going to be relative to other asset categories. And we know that because, for instance, we know the central banks are already berserk, and they're going to go even full berserk, meaning the fiat currencies are going to get flooded with supply of currencies. And they're ready to do it. They've announced it. And as soon as you start breaking, let's say, the Nasdaq 100 and jeopardize their stock market, they're going to push the foot to the pedal even more. And what's going to be a beneficiary of that?
Sure.
Gold.
No, I get that. You're singing my fundamental song. I get there. But okay, so you're bullish. I have to ask.
Gold. Go ahead.
I have to ask real quick though. Same for silver, or do you see silver any differently?
Silver should be stronger. We turned rampantly bullish on silver when it came up through after the March sell-off. It traded up to $19.48. Now its prior high had been above there, the high late last year. But we came up to 1948. Its annual momentum, and we don't have the chart here, blew through a massive flat structure that went back about 8 years, where there was a ceiling on annual momentum. And when we hit 1948 at 20% over that moving average, silver blew through a massive structure. And sure enough, it went from 19 and change to, you know, almost 30. And now what are we doing? We're twisting and turning in the mid-20s. And we think this is an intermediate pullback after a massive price change in silver. We think the tone of silver will stay better than gold in the longer term. We think it will beat on a percentage basis gold. You know, it's called the poor man's gold, and that's probably one of the arguments that it will outpace. There's also, you know, the demand for silver is pretty good. Solar panels, let's say the world goes solar, okay? You know, that's what they're talking about. Well, there's a lot of silver there. Anyway, but regardless of the fundamentals, our measurements of gold versus silver indicate now that silver's period of underperformance, which existed from 2011 through about 2017-18, is now shifted. It's back into positive relative performance to gold.
Well, that's interesting because even those of us who are not MSA practitioners, we all know that silver tends to underperform at first and then more than catch up. So to see that your work confirms that is interesting. And you've already touched on uranium, but let's rewind back to the very beginning of the conversation. I was very interested to hear what you had to say about the broader commodities space. And I'm looking at that too because, you know, the world needs its stuff, right? And we're seeing price breakouts, just price breakouts. And we're seeing, you know, China rebound. You're seeing fundamentals starting to look good despite all the COVID shutdowns and so on. So but there are those shutdowns. So here's one where I got to ask you a fundamental versus technical perspective. Let's say your MSA analysis is very bullish on these commodities. You're seeing a clear indications of a breakout happening. Some of the prices are starting to happen, right? We've seen it in copper and nickel and a few others. But let's say, you know, all of that's fine and it's true, but then the second COVID shutdown happens and everything just gets put on ice. You know, can something like that derail or would you worry that something like that could derail your technical analysis, or how do you deal with something like that?
We suspect that the fundamental driver of the commodity boom, and charts before this, look at the Bloomberg Commodity Index here. Just a second. Okay, this is a monthly price of Bloomberg Commodity Index and a three-quarter moving average oscillator of it. We'll look at those. We'll talk about those right now in a minute. But the obviously commodities went down from 2011 through 2016, and that's when gold went down, right? That's also emerging markets went down pretty big relative to developed markets. Why? Because emerging markets are fairly well connected to commodity prices. There are a lot of commodity producing countries that are emerging markets. So at this point in time, what price did since 2016, it went sideways until they had the little stinger in the tail early this year. But basically, you can't take a commodity to zero. You can try, but you're not gonna. It's not gonna sustain, okay? And ultimately, even the crude thing, which was a phenomenon based on an expiring contract, which is somewhat false, okay? And it bounced back. It's now, you know, $40 crude again. But you can't take commodities, soybean, sugar, gold to zero. They're not going to go to zero. A stock can go to zero, but commodities can't. Okay. Once you realize that, there's a point at which commodities are just bombed out. Now, they may not go up, but they're not going down anymore. And that basically started in 2016 where you went lateral. Some commodities were going up then, some down, but basically the overall complex was just dead. And it was saying, I'm just not going to go lower. Well, it did go lower briefly, a false downside spike that occurred early this year and immediately rebounded. And now that's the price chart. But you can see the Bloomberg is in the 70s right now, and its old high was in the 170s. So it's not like it's expensive. Okay?
Yes.
So to some extent, commodities have already discounted hell. They've discounted any major negative you want to talk about. Their price is off the page. So even if we have an economic slowdown, that doesn't mean that copper has to go down or that oil's going to stay down. Also, if you have economic slowdown, and we probably will in the next year, I think 2021 is going to be hellacious in that regard, the money printing will be rampant. So again, you've got to revert to that other factor. What's your yardstick? If your yardstick is doubling in quantity every year, then, heck with your fundamentals, okay? The fundamental is the yardstick. Okay. Now, when we go to the quarterly momentum oscillator, what this is we plot each month in relation to a 3-quarter moving average. That only changes at the end of every quarter. You readjust.
And sorry, Mike, let me jump in and ask, how do you decide what length of time to use your oscillator? Like this is a 3-quarter, you used a 3-month in the first chart, you use 15-day for gold. How do you know what's an appropriate length of time to use?
We use them all. We look at them all.
Okay.
In other words, if we look at a market, we don't just look at one. Long-term would be quarterly on up to annual. So this we consider a long-term momentum chart. Why? Because when it changes trend, it generally changes for quite a while. Okay. Now, then intermediate would be like using a 3-month. Meaning a trend change there might be worth 3 to 6 months or something. And then we go to weekly or daily, then it's short term. Okay, but we like to look at them all because they're not always going in the same direction. No market goes, like gold has a major uptrend is up, period. No debate about it, both on annual momentum and quarterly momentum, everything. But it turns short term down. Okay, so you have to put that in perspective. The short term's down or it's corrective. That doesn't negate the long term being up. So you have to put those things in a scale. So when we want to look at Bloomberg, we also have run annual momentum of it, and it looks good. But the quarterly is particularly clear. And it's clear for a couple reasons. If you'll draw a downtrend line going all the way back to 2011 on the momentum chart, that's back when price peaked for the Bloomberg, you can connect that high with another high, with another high, with another high. It's a 4-point downtrend line. And in August, it closed above it. Okay, that's a wake-up call.
Mm-hmm.
And then if you look at the momentum chart and plot across all the highs that occurred since 2012, so you go back 8 years, none of them touched 10% over the zero line. One of them got very close there, got 9.9% over. But none of those highs reached 10% over. All got to 8, 9% over and failed. So it developed a ceiling structure. Very clear on momentum, not clear on price. We broke through that last month. We traded 73.50. That's about where Bloomberg's trading right now. When you traded 73.50, you broke through that structure that goes back 8 years. It's defined by multiple highs. So from a momentum point of view, we had a major downtrend line breakout, which you don't quite see on a price chart, not so clear, and a horizontal that's abundantly clear. And meanwhile, when you look at the price chart, you say, well, this rally's coming back up under the prior lows, so maybe that's resistance, okay? Well, momentum says don't count on it. Don't count on that stop in the market. In fact, it's our projection that the Bloomberg, which is now in the low to mid 70s, will be at 100 to 110 probably in the next couple quarters as its next stopping point. Not that that's where it's going to end. That's where the first post-breakout surge is likely to go. We won't go into all the reasons for that. But this is, again, a situation where you look at price and you got this overlaid moving average, and you can see that there are many times you closed over the 3-quarter moving average on the price chart, but it didn't mean anything. The structure that was important was 10% over, as you can see on the momentum chart. So it's not always crossing a moving average that means something. This applies also, let's say, to a 200-day line or a 65-day or whatever the thing is popular. You need to put it on a momentum chart to see whether the crossover is structurally important. And in this case, the crossover didn't occur at the zero line. It occurred by reaching 10% over. So anyway, we've had a full momentum breakout on Bloomberg, and I think it will have wave effects on all the other markets. And one could bring up the issue, well, if the economy slows down, how can that help? Well, because they're priced off the page. Crude oil is no longer $130 a barrel. It's 40, et cetera, et cetera. You go down the line. You look at the grains. Now, when we go inside the Bloomberg and look at the subsets, like the grain, it's a well-balanced index. So it looks at the energy sector. In our view, crude oil is breaking out. Natural gas is broken out. We look at the grain sector. Soybeans were the first to break out. Corn was next. I'm talking momentum now. And wheat recently joined. So we have a full consensus there. Then we go to the soft commodities. Sugar broke out. Coffee, I think, is broken out. Then when we go to the metals, it's copper. Copper broke out over a year ago, well below current prices. Gold broke out, several years ago, way below here, 1200s.
So actually, let me jump in, Mike, because this relates to things I've been talking about, writing about, and what you're saying makes perfect sense to me. And I can certainly see, I guess, my base case expectation going forward, not immediate term, but longer term, is basically stagflation, where we have the people think that the more money is going to increase economic activity. We know, firsthand from the 70s, you had a better vantage point than I did at the time, that you can have high inflation and low growth at the same time. That does happen, Keynesians. So that's my expectation, and that's bullish for commodities, even a crappy economy, because prices are going up by inflation.
Yeah.
But in the very near term, if Europe puts its entire economy on ice again for the winter, and the U.S. maybe, depending on how the election goes, who knows, maybe does the same or not, it's hard to see that not whacking commodities prices. So how do you balance those two?
Yeah, well, aside from our conviction on the long-term technicals, our quarterly momentum breakout, two different ways, okay? And I think the major argument there is commodities are low, period. You look historically back at a given commodity, they are cheap. And so when you throw a negative fundamental at a market that's already discounted, the planet freezing over, okay, it's discounted. You can talk about it all you want. That's why we're low in the first place. It's because we were slowing down. In fact, maybe we really didn't gain much from the 2008 and 9 lows in terms of real economic growth. We had stock market boom because of money printing, but did we really have economic growth in the solid sense of the word? No. And the commodity prices are just cheap. That's it, period. So to some extent, the negative is already built in to the price level of commodities.
That's an excellent answer. And if nothing else, if I had a choice, okay, there's trouble ahead. What do I want to buy? Overpriced stocks or underpriced commodities? It's a pretty simple question.
Well, like Ray Dalio, who's not a gold bug, came out, a month ago and screamed about the monetary situation. He said that, they could destroy the money units. He says, so you people that own stocks, you better quit looking at the price of your stock and look at the money unit, what's happening there. He says, because it's fake, what you're seeing on the stock market. And he had very dire view for the next 5 years. And he's not alone. I think he was wrong in one respect. I think it's 1 year. I think we're headed toward chaos theory in action. It's not an incremental turn in stocks to the downside because they've been overly priced by central banks for the past decade, but commodities to the upside. And I don't think it'll be incremental. I think it could be phases of explosion, much like silver just saw. Went from the teens to almost 30 in a heartbeat.
All right.
Well,
I'm sure that's music to the audience ears. We've been going for an hour now, so we probably should wrap this up. I'll give you the last word, Mike. Is there any one thing that you think is really important that the audience should keep in mind right now?
Well, if you're going to stay in stocks, I think you need to go to commodity related. If I had to put a spread on that was 100% long and 100% short stocks, I think I'd be long EEM, emerging markets, and I'd be short the S&P against it. Have a market neutral position in the global stock market. Because the emerging markets have tended over time, and they are now, they're behaving better than the S&P in recent relative performance. And I think that's due to the shift upward in commodities. So I want to own commodity-related stocks. In fact, there's a few oil subsectors that we're looking at. We know the oil sector has been beat up badly compared to the S&P. And I don't mean the XLE, which is the broad energy sector ETF, but there's some other subsectors that look like you could get doublings in price because they are, one, beat off the page, and two, they have the technical dynamics to go up. And if commodities, in fact, are turning up and oil gets some of the benefit of that, then some of these oversold oil sectors could go up incredibly. And you wonder, well, how can oil stocks go up if the stock market's going down? Well, they went down while it was going up. So, look at history. And look at grain-related stocks, fertilizer companies. That's another example. There are plenty of venues out there that are commodity-related that should benefit in the next year or so, dramatically.
All right, Mike. Well, that was an eyeful and an earful. I'm going to have to sit here and think about it. We'll have to compare notes a few months down the road to see how it all turns out. Thank you very much for your time and your insights.
Thank you for having me on. Appreciate it.
Thank you for watching this edition of In the Pit with Lobo Tigre. If you enjoyed or found value in what you just saw, and you're watching this on any sort of social media, please do hit the like button and the share link. Send this on to anybody you think might be interested. That helps us out a lot. If you're watching this on YouTube, please do hit the subscribe button as well. The number of subscribers helps us get more valuable content to you as well. On the subject of subscribing, I'll quickly say that if you're not a subscriber to our free weekly Speculators Digest, I encourage you to sign up. I promise if you do, we will not send you a flood of daily advertisements. You get one free weekly digest with original research not published anywhere else. Check it out at independentspeculator.com. Thank you and have a great day.